Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
You get the idea?
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
and tell him that his love
Here's the Sandman.
over Sandman.
So I need to ask you a question. Are you smarter than an 8th grader? Reason being is this past week, my buddy Jim told me a story about how the other day he and his daughter Jessica were making lunch in the kitchen when out of nowhere, Jessica asks him if the bear market's going to ruin Jim's retirement. You see, Jim did well and sold his company about a year ago. And since then, he and his wife, Linda, have been retired. But now that a bear market is upon us, Jessica wanted to know if they were going to have to sell their house and move. Well, Jim started rattling off to me facts about the bear market that he didn't know, like we're officially in a bear market when the market falls 20%. And let's face it, last week, it was down another 1.6%. That's the S&P 500. More on that later. Long story short, my friend nearly fell over. Not because he thought she was wrong, but because one minute they're talking about what kind of cheese they should put on their turkey sandwich, and the next minute Jessica's talking about bear markets and how they can ruin the family's otherwise peaceful existence. Don't breathe on me. So that got me thinking. This is exactly what's on everyone's mind right now. What is a bear market, and what do you need to know about them? Even an 8th grader knows it. So today, I thought I'd give you the bear market quiz and see if you know more than an 8th grader. Good morning. How are you doing? This is Protect Your Assets. I'm David Hollander, also known as the Sandman around here. And that's because I help my clients and friends and listeners sleep well at night by answering their most troubled legal or financial questions. And that's because I'm an attorney and a financial advisor. I've been doing this for a long time, almost 30 years. We have a lot to talk about today. If you're feeling a bit nervous and unsettled, then that's good. You should. This is about as volatile as it starts to get towards the end of a cycle. I mean, it certainly can go down more, but that shouldn't matter to you if you're protected. You see, it's not about return in retirement. It's about income in retirement. If you've built yourself a Sherman tank when it comes to income, this kind of volatility, well, it's just noise that you'll have to deal with as sure as the sun. It's out there somewhere. It'll rise today. So what can you do right now to protect yourself? Are you able to recover this late in the game? Are you still able to retire, even though your 401k is now down 30% or more? Well, if this year has rattled you at all, then you can't afford to miss the show today. So stick around now. Let's get started. Yep, another week of significant volatility on Wall Street. Dow Jones, guess what? It finished up the week a little bit, 1.2%, but we're off almost 20% year to date. S&P 500, well, not as good, down 1.6%, off over 24% year to date. And the NASDAQ, which I know a lot of you own, technology, down 3.1% this week, off over 34% for the year. And if you hold international, judged by the EFI MSCI, you're down almost 30%. Bonds off over 15%. So it seems like there's nowhere to hide. And this volatility has got a lot of you rattled. I know that because we've been hearing it all week. Now, what happened this week and why was Thursday such a incredibly volatile day. Well, let's analyze that because I think it's a great place to start in terms of just what volatility means in a bear market. So Thursday, stocks staged in a historic rebound. I was watching the market in the morning and it was down, went down almost 3%, S&P 500 now is what I'm talking about, to close up almost 3% by the end of the day. So that's about a 6% move in one day. Why did that happen? And I know you want to know, what does it mean? Great questions. So let's think about this, because you always have to apply knowledge to what's going on. Otherwise, you're going to do the wrong thing. It's that simple. So let's look at the reasons why Thursday was such a volatile day. First, positioning. You may want to write these things down. These are terms that we use on Wall Street, something called positioning. Now, funds, managers were positioned before Thursday for what we're going to call a hot consumer price index, CPI report. We're all waiting for that Thursday. So they were positioned, meaning they bought certain things to get ready for a report that would be hot. Hedge funds were extremely short going into that news on Thursday. Now, what does that mean? Well, when they go short, they buy things that are contrary to the market. In other words, shorting the market. That's what that means. A little bit more about that in a second. So once the markets opened, the funds began to cover those shorts, and that leads to what's called a squeeze because there's just not enough supply out there. So that's what's called a textbook sell the rumor, buy the news. You may want to quote that because that's straight off the Fed itself. Okay, so that's what happened. That was one reason to cause that sort of volatility. The second reason that day, this all kind of lined up this one day. Trust. You know, we've been talking about Prime Minister Truss now for a while. This is the UK again. The Brexit, all that business, right? Remember this little country out there? I know, sorry, I'm not saying anything negative about England. It's just something happens over there and the whole world reacts, right? So UK Prime Minister Truss, she essentially, which we asked for a few weeks ago, I know she wasn't listening to me, but we essentially asked for a U-turn. In other words, for her to say, hey, I'm not giving fiscal stimulus to individuals because inflation's going crazy right now, and that's contrary to what the Bank of England is trying to do by raising rates. We said those two don't work. And, well, she did a U-turn on Thursday, essentially firing the fellow who made that great call, which was not great, fired him and replaced him and said, you know, publicly, hey, we're not doing that anymore. Market liked that. So that happened. The next reason was the ECB, the European Community Bank. There was a Reuters report that happened to hit that morning, which basically implied that the bank, again, these are the people that raise rates in Europe, that the terminal rate may be 2.25%, which, by the way, is 75 basis points, 0.75%, less than expected. So anytime we're going to hear that rates are slowing down or they're stopping that stuff, you're going to see the market go in a positive direction. That's just the way that works. So that happened Thursday. I'm not done. Then we had earnings. And you know, I've been talking about this for a while. We had Wabtec. The symbol on that's WAB. Remember Westinghouse? Yeah. Well, that's something called Wabtec now. Anyways, it's related to Westinghouse. Delta Airlines, which, of course, if you've flown anywhere or gone anywhere, you see how crowded these airplanes are. How could they not be making money? Louis Vuitton, Pepsi, all these companies reported good news. In fact, better than expected. And as long as that continues, the market likes that. So, what does that mean for the market? Well, I'm going to tell you, in reality, not much. Because stocks were frankly oversold when all this stuff hit. Now, the positive lining through all this is if we can get more positive earnings this next week and the weeks to come, you're going to see strength or positivity in the market. And I think the S&P will probably stay at this range or high 3,000s. I don't see much more than that. But I don't want you to confuse any of this strength, which I'll call it moderate strength, with a reversal or a bottom. Because markets have become numb to high inflation and a Fed that's hawkish. And this will continue to weigh on the market until we see that inflation is actually declining, which we didn't see Thursday with the CPI report. Still hot. And we see the Fed say, you know what, we're done. We're going to pause or we're going to turn around and go the other way. We need those two things to happen to get a meaningful correction on the other direction, going back up again. Those are the two things we have to see. And so I would say right now, since you see these bounces, and they call them all kinds of things, dead cat bounce, whatever. I mean, this stuff happens. And so maybe you use that as the potential and the timing to right size your portfolio, meaning maybe you're in some stuff that you shouldn't be in. I'll talk about this, how you figure that out a little bit in the show here, but that could be a warning sign to you. All right, now what about the economy? Well, the CPI, like I said, it came out. The September CPI rose 0.4%. The estimate was 0.2%. So we had another reading year over year, 8.2% on inflation. And that's another month that was hotter than expected, showing inflation still here. And like in August, the CPI showed that prices across the board are going up. We all know that. We're feeling it. We talked about that last week. This report happened to focus on housing and rents right now. Check this out. Rents rose 0.8% for the month. This was the biggest jump we've seen in rents since 1990. So the bottom line is inflation is sticky and it's still around. And so that's why the Fed's going to keep doing what they're doing. So I don't expect this to go away for a little bit of time. Now, what are your support levels? What are the indicators you should be looking for? On the upside, on the S&P, right down 37.91. If we get through that, it could go higher. On the downside, right now, 35.34. I know what you're saying. What if it hits 35.34? Then what? Good question. 34.27. All right, write those down. So if we go through those, we close below those with volume. It's just more pain, folks. That's just what's going on. So next week, there we go. So next week, I'll give you an example. We are looking for housing numbers. Housing is going to be a very interesting area. A lot of people said you missed the market. If you're trying to sell right now and you can't get bids or prices on your homes, you may want to pull it off. This may not be the time to be selling real estate. Why? Look at the 30-year borrowing rate right now. It's over 6%. It's a lot of money. So a lot of the buyers are drying up and going away, and that's not good if you're trying to sell something right now. So anyway, we'll see what happens. According to S&P Dow Jones Index, the average bear market decline in the S&P 500 since 1929 is... Find out when we come back. You're listening to Protect Your Assets. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I'm David Hollander, also known as the Sandman around here. And you're listening this morning to Protect Your Assets. And this past week, I got an interesting call from my buddy Jim, who was telling me a story about how the other day he and his daughter Jessica were making lunch in the kitchen when out of nowhere Jessica asks him if the bear market's going to ruin their life. You see, Jim did well and he sold his company about a year ago. And since then, he and his wife, Linda, have been retired. But now that a bear is upon us, his daughter, Jessica, wanted to know if they were going to have to sell the house and move. Well, Jim started rattling off all these facts about past bear markets that his 8th grade daughter knew, but he didn't. And that got me thinking, inflation may be on everyone's mind right now because it's not going down. But what should you know about bear markets and your money, since it seems like we're in a pretty long one right now? So today I thought I'd give you the bear market quiz and see if you know more than an 8th grader. Now, let's start the quiz, shall we? Because you want to know something, hopefully more than Jessica, right? She's an 8th grader after all. And how smart is she? Well, let's get ready to see this one. So, here we go. Stocks are officially in a bear market when A, at least 2 major business publications proclaim a bear market on their magazine cover. B, stock prices end lower in the majority of trading days within a 90-day period. C, a broad market index such as the Standard & Poor's 500 falls 20% or more from its peak. Or D, the National Bureau of Economic Research declares it so. That's kind of tough, right? What do you think the answer is? People are looking at me. One said B. No, it's wrong. The answer is C. A broad market index such as the S&P 500 falls 20% or more from its peak. Now, the average bear market decline in the S&P 500, this is what I told you before the break, since 1929. Are you ready for this now? Please don't freak out. The average fall since 1929 is 39.9%. It's very true. And this is according to S&P Dow Jones Index. So if we finish down Friday over 24% from the recent high, then you can be down about another 15%. You feel that? You hear that? So I know you've been asking all week, when's this going to end? How far can it go? There's the numbers. That's what can happen. So the last thing you want to do is panic right now and think you can just sell everything, go to cash, and just wait and buy back in. I'll talk about that later statistically and what that means and why you don't want to do that. But anyway, there's your answer, okay? By the way, Jessica knew that. Next question. Ready? Which of the following is least likely to cause a bear market? So least likely to cause a bear market. A sputtering economy. B, high interest rates. C, military conflict or geopolitical crisis. D, rising inflation. Now, what I found fascinating about this is every one of these sound pretty bad, right? And by the way, all this is going on right now. If you think about it, right? All going on right now. So which of the following is the least likely to cause it? You think B? All right, B is what I heard. No? A, okay, you're wrong. The answer is C, military conflict or geopolitical crisis. That's the least likely of all of those. Anyway, so far, this is so far, by the way, because this could change next week with Russia and Putin. Who knows? The guy's nuts. Anyway, so far, military or geopolitical shocks to the market have been mostly fleeting in that 2 of the longest downturns followed the attack on Pearl Harbor in 1941. It was 308 days. And Iraq's invasion of Kuwait in 1990. Remember that? 189 days. But the average time, ready for this? The average time to the market bottom after such an event, which also include the terrorist attack in 9/11, And the North Korean missile crisis, by the way. 21 days. Yeah, 21 days. With a full recovery, this is even better, in 45 days. And that's on average. Isn't that incredible? Think about that. Amazing. All right. She knew that too. Next question. How do you know you're in a recession? Now, this is a tough one. How do you know you're in a recession? Because if you think about this right now, most people haven't said we're in a recession yet. They keep saying next year is going to be a big, bad recession. And I've been saying we're in a recession now for a couple months. Go back and listen to the market segment. All right. How do you know you're in a recession? David Hollander says so. That's not actually a question. A, the price of your lunch goes up 20%. B, the market goes down for 2 consecutive quarters. C, gas prices are over $7 a gallon. D, your daughter asks you for a 20% raise on her allowance. The answer is B, correct. A recession is a contraction of a market for 2 consecutive quarters. Now, like I've been saying, the market's been going down for 2 consecutive quarters. They like to look at this in different ways, yes, but that's how I look at it. And as you know, we've had 2 negative quarters now, or a third negative quarter. So I say we're in a big recession right now. And the big question is this: how serious and how long will this go on? If that's what you're thinking right now, you're not alone. Because guess what? This year, 2022, has been one of the toughest in markets since 1929. Can you believe that? Bonds are down. Stocks are down. Seems like there's nowhere to go. So we'd like to help you make sure that your retirement doesn't suffer because of what we're going through right now. So to help you this morning, we are currently scheduling quick 15-minute phone calls to discuss what your options are right now to make sure you're protected. If you want to schedule your complimentary meeting right now, then this is what you need to do. Pick up the phone and dial this number, 866-776-8328. Again, call 866-PROTECT right now. I've got 2 fellas here, Adrian, Cam. They're nice guys. Talk to them. Hey, guys. Say hi and say, I want the 15-minute free checkup. All right? This will not cost you a nickel. And we're going to use our proprietary software right now to find out how much you could lose in the next 6 months. If you want to know that, call this number, 866-PROTECT now, to protect your downside. 866-PROTECT. Now, coming up next, it's time for our popular They Say segment, where they say bear markets happen once every 10 years. Is that true? Find out when we come back. You want to keep it tuned right here. You're listening to Protect Your Assets with me, David Hollander, the Sandman. We'll be right back.
Now you can hear the show Protect Your Assets hands-free anytime on your smart speaker or Android device. Just say, hey Google, ask Protect Your Assets to play the latest podcast. Learn more at libertygroupllc.com/voice. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I'm David Hollander. I know you have it bad, especially when this week has been so volatile. So this morning you're listening to Protect Your Assets to find out what you can do. This past week, Jim called me to tell me about how he was making lunch with his daughter in the kitchen. Her name is Jessica. And by the way, she's an 8th grader. And she started asking Jim about a bear market and how this bear market could potentially force them to lose everything and sell their house and move. And Jim freaked out and called the Sandman, of course. And that got me thinking, because this has been a very interesting year. Bonds are down over 15% year to date. You got the S&P, the NASDAQ, all in bear market territory. It's a very interesting bear, not your normal bear. And you get all these people starting talking about new things that are happening. And of course, that's when everyone starts to get nervous. So we're doing a quiz today about what are bear markets and how long do they last and what should you know? And do you know more than Jessica does? So that's what we're doing this morning, to see what you know about the bear market that we're in right now and how long it will go on. Now, it's time for one of our fan favorite parts of the show, our They Say segment, where we debunk common myths, half-truths, and sometimes just bad advice that they say.
Who are they? What do they know that I don't? And what are they saying this week? Here's David Hollander, the Sandman's answer.
All right, so here's one they say. They say that bear markets occur once every 10 years. Is that true? Nope, false, not. Since 1932, bear markets have occurred on average every 56 months, or every 4 years and 8 months to be exact. And you're right, we just had a mini bear through the pandemic, and now we're back in one again. So that's even less time. Okay, next question. By the way, Jessica knew that one. How about this one? Jessica knew this too. True or false? And we're seeing this morning if you're smarter than an 8th grader. Ready? True or false? You'll know a bear market is coming when you're in a recession. True or false? You have a 50% chance. Come on, give me an answer. False. Okay, you're right. False. According to Investec research, bear markets usually precede recessions. Since 1948, 8 of 11 bear markets have been followed by recessions. In one case, the start of the recession came at roughly the same time as the market's peak. The longest wait was 12 and a half months, while the average time between a peak and the onset of recession is 7 to 8 months. So for all of you wondering, how long can this last? 7 to 8 months on the downside. Well, guess what? It's already been more than that. And on the long side, 12 and a half months. So, yep, just depends on when you draw the line on this thing, but that's why I'm saying early to mid next year is what I'm seeing right now. Okay? Good question. Thank you. And yes, she knew that one too. Now, I got a question, which is, why is the 1.5-year Treasury right now paying a 4.58% interest rate, this is as of Friday, versus the 10-year Treasury, which is paying 4.01%. So you're talking about 1.5 years out, you're giving the federal government your money and then they're going to give it back to you, versus going 10 years out, same story, where they're paying you less. So you're giving them your money for longer, but they're paying you less. You understand the question? Why is that happening right now in this bear market recession that we're in at the moment? Because we're in it, both of those things right now, according to me, okay? All right. What's the answer to that? Why is that happening right now? Why are short-term rates higher than longer-term rates? Well, it was because of the hot CPI report we saw Thursday. As a result of inflation staying at this sticky high level, over 8% year over year, the Fed is raising interest rates. They're raising the short-term interest rate. And that has a direct correlation on the shorter-term treasuries. something I've been talking about for a while called the 10-2 spread. Remember that? Inversion. If you're a student of this show, you know what I'm talking about. When the 2-year Treasury is paying more than the 10-year, that's called inversion. And that signals that we have some economic problems and slowdown and contractions that are occurring. That's what all that means. So right now, don't expect yields. Don't expect bond yields to drop anytime soon. Next question. The worst bear market in history of the U.S. market was A, the 2008-9 Great Recession, B, the dot-com collapse of 2000, C, the 1973-74 President Nixon getting impeached, but he actually resigned, and we had the Arab oil embargo and interest rates went crazy, and you can get over 12% in CDs at the bank. Or D, the crash of 1929. Yep, you got it. Answer is D. Good job. The bear market from September, what month are we in now? Yep, October. September, October, just is not usually great for the market. So the bear market happened September 29, went through June of 1932. Yeah. That resulted in an 86.2% loss for the S&P 500. Think about that. The other ones we were just talking about aren't even close, with losses of 56.8% in 2007, 2009. We all experienced that. That wasn't fun. 56.8%. Or 2000 through 2002. That one was pretty bad too. Down 49.1%. And 73, 74, for those of you who remember that one, down 48.2%. So after the 1929 through 1932 crash, stocks did not regain their prior peak until wrong. 1954. Think about that one. 1954. It's a long time. I don't know when this is going to end. I gave you an opinion. I think I know, but I don't know for sure. I don't think anybody really knows. So how can you? What can you do if you're thinking of retiring right now or you're retired to protect what you've worked so hard for and to make sure you don't run out of money and income? You may still have options, but all you have to do is pick up the phone right now to find out. Call this number right now, 866-PROTECT. Because it's so volatile right now and so scary, we are scheduling 15-minute crisis calls right now with one of our certified financial advisors to help you figure this out. Call this number, 866-PROTECT. Get access to our proprietary software. We can show you things you've probably never seen before and learn something new at no cost if you call this number, 866-PROTECT right now. Talk to Adrian or Cam and set that meeting up. 866-PROTECT and get some help from a fiduciary. It's time for a quick break, but when we come back, find out how long this bear market should last. It's all coming up next, so stick around.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I'm David Hollander, also known as the Sandman. And you are listening to Protect Your Assets this morning. And I know that name right now, Protect Your Assets, is relevant when, let's face it, it's been a tough year so far. And this past week was certainly volatile with one day move over close to 6% on the S&P 500 in one day. We have markets down over 30% in some cases, and you're wondering what you should do. So this past week, my buddy Jim gave me a call, and he told me a story about how he and his daughter Jessica, who's, by the way, in 8th grade. Yep, 8th grade, sitting in the kitchen, they're making lunch, and she turns to her dad and says, "Is this bear market going to ruin us, Dad?" And he said, "Well, what do you mean?" And she started throwing all sorts of statistics at him. And at the end of the lunch, who do you think he called? Me, to start sounding off all these things that he had learned from Jessica and wanted to know if this bear market recession we're in right now was going to force him to have to sell his house and change his lifestyle. Are you feeling that way right now? Well, if you are, you're not alone. So this morning we are taking the bear market quiz to find out some answers to the questions that are probably floating around in your head. So the next question that Jessica, again, knew the answer to was this, which is what's on a lot of people's minds right now, is this: how long is this bear market going to last? Ready? On average, bear markets last A year or less. B, a minimum of 2 years. C, 21 months. Or D, seems like forever. All right, someone said A. It's not right. It's C. Since 1929, the average, again, these are averages, the average bear market lasts 21 months. Yeah. Now that brings me to a lot of the noise that I've been hearing this week, which you may be thinking as well, because you're hearing it from so-and-so or on this show or whatever. This is when they all come out. The market timers. Now's the time. The ship's sinking. Jump off. Sell it. Get out. Right now. My software says so. Da, 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 da. Ready for this? Here's the cost of trying to time the market. Get ready for it. First of all, I don't know of any way. There is no proven way to time the market, meaning get out at the right time and get back in at the right time. If you know of a way to do it, call me, because there is no way. You cannot target the best day or moving to the sidelines to avoid the worst. So the evidence suggests staying put through good times and bad as long as they meet your economic makeup in retirement, if that's where you're going. And that's a lot right there, what I just said. And you need to figure that out for you, not for this, well, everyone else is doing this, No. We can figure that out. We have something called your sleep factor number. We can dial in the portfolio to fit your feelings as long as it works out in your financial plan. So there's two things that go together that you have to get right. It's like making a recipe. When you do popcorn, and if you do it just right, it comes out. But if you cook it too long, even 15 seconds too long at high heat, what happens? It burns, it stinks, it doesn't taste good. And the same can be said about your retirement. It really is that. I don't want to call it simple because it's not. It's advanced, and we do that sort of thing. But anyway, I digress. The impact of being out of the market for even a short time can be profound. Listen to this. So the hypothetical, by the way, I'm going to give away these PDFs I'm looking at right now. I'll wait for it. The hypothetical I'm about to go over is in the Russell 3000 Index, which is a broad U.S. stock market benchmark. We look at $1,000 investment made in 1997. If you waited 25 years through December 31st of this past year, 2021, you would have made $10,367. So your $1,000 would have grown over tenfold to $10,367. Now, if you missed a week during that period of time, you would have 8,652. If you missed a month over that period of time, you would have 8,279. And if you missed 6 months, you would have had 6,728. So the moral of the story is you can't time this stuff. And if you look at what happened Thursday, it's a great example of a 6% move in one day. History shows that stock gains can add up after big declines. Now, this is another chart I'd love you to get a copy of, so I'm happy to share this with you. According to Fama French, when you have a big market downturn like we've experienced so far this year, I know it's unsettling. But history shows that usually after a 30% market decline, right now on the S&P, we're between that 20 and 30%, but if you're in the NASDAQ, you're down over 30. History shows that 1 year later, those indexes can be up over 23%. 3 years later, and these are annualized returns, 16%, and 5 years, over 50%. So what can you do right now about this? Here's what I want you to do. If you're driving, please pull over. Here's what you do. Inhale through your nose. Exhale through your mouth. And picture in your mind, because I want you to close your eyes. Picture in your mind a day when you don't have to worry about the stock market anymore. Picture a day when you're on a beach in Hawaii or wherever you're, Fiji, wherever you want to go, sitting under a cabana because you rented that cabana for the day and you weren't worried about how much it cost. You're drinking a pina colada and your wife looks at you and says, "Thank you for making this happen." And you guys are not worried about a thing. Picture a day when you can relax, travel, and do all the things you've been working so hard your entire life to do. Well, it all starts with our 15-minute crisis call, because we're in a crisis right now and you need help. So set up your complimentary meeting right now with me or one of our financial advisors by calling this number, 866-PROTECT. Find out how to protect what you've worked so hard for your entire life, because we could go down another 15%. 866-PROTECT. Last chance. 866-PROTECT. I'd like to give a big thanks to the Protect Your Assets team for putting together a great show today, because without my team, I'm just another pretty voice on the radio. Thanks again, everybody. You've been listening to Protect Your Assets with David Hollander. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You're listening to the Protect Your Assets Radio Network.